Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Good morning. My name is Anthony Wolfenden and I'm a tax financial advisor. Welcome to Tax Tuesdays and Wealth Coffee Chats. I'm here to give you an update on the Div 296 super tax, the tax that the Treasury and the current Treasurer, Jim Chalmers, have been chasing now for well over 2 years. As you might have heard, there are some changes to what they're proposing based on some fairly stiff feedback from the public. They're not changing the core idea of the tax, which is to tax 30% of income and gains for balances over $30 million. They're adding a new threshold to tax 40%, which will be the highest entity rate for anything that sort of holds money in Australia. The balance is over $10 million. This is going to now be on realised gains, I beg your pardon, not unrealised gains, which was the initial proposal. So that's a win, and it won't be made retroactive. It'll be legislated and take place at some point after the legislation receives approval from the Governor-General. But let's be honest about what's going on here. Treasury have identified that basically there's a massive revenue hole. We have a situation where cost of government services, particularly NDIS, aged care, and some other services are likely to balloon in double-digit numbers each year into the future at exactly the same time that the number of people entering the workforce and thus having their income available to be taxed is actually reducing. And of course, incomes are not going up at anywhere near the same extent as some of the costs associated with them. So there's a massive budget hole basically the government needs to fill. And rather than doing a sort of a holistic tax reform, which might be beneficial to the entire country because we do rely in Australia too much on income taxes. They're basically making a cash grab on larger super balances. If that's all it was, maybe that would be okay. I don't know. That's something we could all discuss. But because of the way they're doing it, because of the way this is coming in, and because we all understand what's going on, the impacts here are likely to extend much beyond the basic cash grab. So what it's very likely to do, of course, is increase the cost to everybody who has super, not just the folks who've got balances over 3 million. Every super platform will have to implement new systems to track gains above certain amounts. So this is new systems and tools that will have to be implemented. It makes tax legislation and superannuation law even more complex than it already was. Most people don't follow it anyway. It distorts investment behaviours for folks who do have super. They'll be looking to delay gains and do all sorts of other things to try and avoid the tax. And of course, what this all does is reduce confidence in the Australian retirement system, which is currently the second largest one on earth, one that we all hopefully should be able to rely on, but of course may not be able to because the government keeps moving the goalposts. Again, if this was part of an overall holistic reformation of the tax system, it would be arguable to make a series of changes. But of course, they just poke and prod at various things to see where they can raise some money. Additional risks that are coming up for this, of course, involve, well, if you can do this to the super system, where we all have a super account, and they get away with it, I guess, without too much fuss and bother, that would open up the door to changing rules for unrealised gains or realised gains on discretionary and other types of trusts, on companies, on private individuals. You can bet that death duties and wealth taxes are on the way. Why? Because Treasury have talked about it. So it's not a secret. These things are all potentially coming our way, and doing it piecemeal without some overriding set of principles or anything else is just not the way to play with certainty in Australia's tax environment. But of course, this is what they're doing. So some minor wins, not taxing unrealised gains, potentially not making it retroactive, so at least people can plan when they understand more about how the legislation will work. But overall, a pretty crappy approach to how to maintain or manage tax affairs in Australia. So we'll learn more as the legislation comes through, but that's an update on the state of play for now. If you guys would like to have a chat with anyone on the tax team, feel free to scan this little QR code. We're always ready to have a chat. And other than that, we'll see you next Tuesday.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.